Hello, friends. Welcome to the Weekend Investing Daily Bite of 23rd of January. A slightly better day, I would say. Banking still not participating in the bounce. Rest of the market trying to move up, especially IT stocks. The mid-rung IT stocks did really well. Coforge, Persistent, etc. Defense stocks did well. I think the market is attempting a bounce at least right now. We have, I would think. Just 4 or 5 sessions, 6 sessions before the budget is announced, there is already murmurs that uh, with high probability there is likely to be some relaxation in the slabs that will give more money in the hands of the middle class. There is also rumored confirmation that there is no change on capital gains. So I think just brushing aside all rumors also may not be such an intelligent thing. I think there is no smoke without fire. So there is likely, and in my opinion, last year the FM had said that they are making a structural change to club all short-term entities at 20%, all long-term entities at 12.5%. I will give her the benefit of doubt right now that she will not tinker with those rates this time at least. But if she does, I mean, there'll be complete non-belief going forward. Other than that, I think the consumption stories have already started to move up or bottoming. The results from Hindustan Levers, HDFC Bank are not exciting at all. So we are in this, sort of a quicksand area for some time, I think. We may spend more time here, and then maybe some base will get formed at some point and we'll move back up. So, given the context, I think expecting a very sharp bounce back recovery or back to all-time highs probably is not happening anytime soon. We'll cover a common uh, mistake made by many investors related to which segment of the market they should be in. We'll talk about this in the second half of the video. The disclaimer is to be read fully, and the channel is to be subscribed if you haven't so far. Where is the market headed? Market spent the second day on the side, 0.22%. No big deal really after this huge smash day that we had 2 days back. We can always have 3, 4 such days and another smash down. That is always a possibility. Only if we move above this smash day high will some confidence start to come that yes, maybe we are trying to build back up on the higher side. So right now it is just a reaction to this down move. Uh, Tomorrow, if we move above today's high and close, that will be the sort of the first indication of a positiveness. But if we slump tomorrow down again, then of course we are going downwards again. Nifty Junior was up 1.01%, so it has recovered all that was lost yesterday. Nifty, of course, has moved up from where it was 2 days back. Junior Nifty is exactly at where it was 2 days back. So no harm done as such in the last few sessions here. Mid caps are looking more robust, 1.78% on that. And we are beginning to move up from this sort of double bottom that we have here. Still not out of the woods. I would like to see at least a close above 2450 right here. Small caps also moving up slightly, 0.81%, but certainly not out of danger territory. We can still, slump down from here in a day or two. 0.8% on small caps. Bank Nifty, as I mentioned, did not move up. 0.28% on the down. HDFC Bank yesterday post results was up, but today I think people read more into it and were not very happy with it. Down 0.28% on the overall banking index. Momentum trends reasonably towards the green, so there is some reactionary bounce today. 340 advances to 160 declines. Heat map very mixed. You had some cement, IT, some autos, some of the FMCG, some pharma. These stocks moved up. Energy stocks, Reliance, BPCL moving down. Coal India was up. Then you have banking names. HDFC Bank was down much more, but has recovered towards the end. State Bank of India down 1%. Kotak Bank also down. Axis Bank also down. So the banking space is not moving up net net. In the next Nifty next 50 space, you had more greens. So you had consumption stocks like Pidilite uh, move up. You had pharma stocks like Torrent Pharma, Zydus move up. Zomato and Indigo also moved up. United Spirits moved up. Ambuja Cements moved up. You have Havells, Siemens, Motherson, Capital Goods move up. Geo Finance was smashed down, and others were reasonably flat. In the sectoral trends, you have IT stocks 1.8% up for the day. So IT stocks have moved into the green for the week. Pharma also up 1.4% for the day. Pharma is now the leading sector for the week. Autos up 1.1% for the day. Real estate making a small recovery after a badgering this month of 18.8% total. Commodities and consumption stocks also up 1%. What was down was private banks, largely minus 0.4%, Bank Nifty and PSU Bank. So banking space is still lagging. They are not willing to bounce at all. Overall, if you see in this last 1 week gone by, not much has changed except maybe real estate and pharma on the two sides of the line, but others have been reasonably flat, I would think. The IT space is looking energized. You had Coforge, Persistent moving up in double digits, Emphasis, Wipro, LTI, Mindtree also moving up. So this is certainly a rub-off from the healthy US markets, and it seems that the USD INR moving down also is helping these stocks. So what is the mistake that we are talking about in terms of don't make the costly mistake now? We are talking about small caps versus large caps. So if we see in this chart in the last few months, since let's say 11th of December, Nifty is down 5%, but small cap index is down 11.5%. So small caps are moving down much faster. And the usual narrative that small caps are likely to crash, time to move money into large caps, so on and so forth is on. Let's see what the history has to say. When the markets go up, small caps tend to outperform large caps. When the markets come down, small caps tend to underperform large caps. So let's analyze some past bull rallies. So in the 2003 to 2008 rally, you had uh, small caps go up 2000%. Uh, and Nifty was up 1442%. But for this specific period that we are showing, it was up 315% on Nifty and 652% on CNX small cap. Then from 2009 bottom, you had small caps go up 550%, the golden line, and 290% on Nifty. Then you had another rally from COVID bottom. You had small caps go up to 40% versus Nifty at 125%. And let's also look at past corrections. So in the past, from 2008 top, you had a 59% correction in Nifty, and you also had a 77% correction in small caps. Now imagine small cap index going down 77%. What happens to the constituents therein? In the 2010 to 2013 correction, Nifty was down 12%, small caps were down 45%. In the October 18, January to October 18 correction, you had small caps go down 40% almost, while Nifty stayed 2.85%. And in the recent pre-COVID or post-COVID or within COVID downfall, you had Nifty go down 28% and small caps were down 64%. The percentages may be a little off in terms of the net fall. Nifty may have fallen 32, 33% total, but from the point where we have taken, this was 28% versus 64%. In the recent 22 fall, you had Nifty fall 16%, small caps fall 33%. So almost all the time you will find that on the higher side, small caps take a outperformance. On the lower side, small caps underperform large caps, and that has been the cycle. So if we see this ratio of Nifty to small caps, large caps to small caps, this ratio has been swinging between, let's say, on the higher side 2.2 and on the lower side around 1.2 or so. And every time it swings higher and lower, the the different side of the market performs. So when this ratio is coming down, small caps are performing better. When this ratio is going up, large caps are doing better than small caps. Again, small caps are doing better. Again, large caps are doing better. Again, small caps are doing better. large caps better, small caps better, so on and so forth. So the common mistakes made by uh, most folks is to try and enter large caps when at these extremes, where you were supposed to enter into small caps, or try to enter small caps where you were supposed to enter large caps. So right now we are at that point where the history is indicating that this is now a better time to enter large caps than small caps. Uh, does it mean that you should exit your small caps? I don't think so. The only sense that this tells me is that the large cap performance may outperform the small cap performance. So, for instance, in the next 2 years, if small caps perform, let's say 15%, large caps may perform 20%. That is probably the outperformance that we are talking about. So, instead of trying to see it one versus the other, we should try to see it, the allocation of one could be higher as we come down this chart. So as we are coming down here, we could uh, uh, have more large caps. As we go higher here, we could have more small caps, and so on and so forth. So that's a tactical allocation that one can do. Of course, the healthy mix is always good. So depending upon your risk profile, you could allocate yourself in mid, large, and small caps spaces. And if you wanted to do a tactical allocation, you could use charts like these to make a tactical allocation that, okay, I have three strategies. I've right now put equal money in all of them. Maybe it is time for me to take off something from the small caps, not have 33% allocation, but maybe 20% allocation there, and I move that additional 13% to my large caps. That kind of a tactical allocation can be done. I certainly won't feel very comfortable if we get out of any of these segments. So don't get out of any of the segments, but make tactical allocations if you have to. Also, a lot of folks do an annual or a biannual kind of a rebalance of their allocations. That also some people can try. That let's say I have three asset classes, three buckets in my portfolio. I have gold, I have large cap, and I have small caps. Let's, for simplicity's sake, we have these three. And in the last 1 year, small caps have done really well. Okay. For instance, so my 33% has gone to, let's say, 53% on small caps, and the rest have obviously reduced because this one component has almost doubled. So at the end of the year, I'm taking off some money from there and allocating to my other two buckets, and then let it play for another year and then see where it goes. So that is another way of sort of allocating to different asset classes or different buckets in the market. Let me know how you handle your allocations. Do let me know in the comments whether this makes sense for you, and are you making these mistakes, and how you're going to get out of those mistakes. Thank you so much for watching. Do like and share these videos. If you do subscribe to the channel. We need your subscription to remain motivated to continue doing this. Please share this with your friends and family and help us in propagating this channel. Thank you. Bye.